I was at a conference, PennyMac to be exact. PennyMac invited me and a couple of my sales staff down to Southern California. They kind of wine and dine you and just kind of let you know what they're up to. One of the cool things about PennyMac is they're now the head sponsor of the 2028 Olympics, which is cool, and the Paralympics, which was really neat. So a lot of pride, a lot of energy there. And I just kind of really enjoyed that moment, and this prompted me to kind of write this video. But one of the speakers was, I think her name was Dr. Julia Lutz from National Association of Realtors, and she's an economist for them. And one of the things she talked about was home equity. And I don't traditionally talk about home equity here. We do a ton of it, but home equity lines of credit, so HELOCs. And she had the most interesting story. And so I kind of wanted to share it with you guys informally, impromptu, right here. So she had mentioned that her auntie had bought a condo, I think it was in Florida, and she lived there forever. She's an older gal and lived there forever. And she needed to downsize. And so she was looking to downsize, but she didn't fully understand how equity works in a home. She was talking to Dr. Julia and she was like, so how do I get access to this equity? Do I call my real estate agent who sold it to me, 25 years ago and say, can I have access to my equity? How do I access the equity so I can buy this other condo and sell this home? And she had one other story, which I thought was really interesting too, kind of along those lines. And it made me realize that we're in this all day, every day. So we're like your chemistry teacher in college. I remember my chemistry teacher in college, and he's just like, how did you not know that? Like, it's so basic. And it's just such a basic concept that even the professor forgets that it's just not everyday talk, right? So one of the things I wanted to do today was kind of talk about HELOCs, the untapped portion of it, and then kind of how it works and how you can access it. And we certainly can help you access it and educate you on the process. And that's one of the reasons I'm here today. So thought that was an interesting story that most of the time people may not realize how to access that equity. And that's one of my job is to help educate families on how to access equity if they need to. Okay. And we're hearing a lot of stories these days with people who bought in 2020, 2021, and they're locked into those low interest rates, and maybe they're struggling. Maybe they want to reinvest the equity in their home into buying an investment property and wealth, or maybe they want to renovate their home, but they just don't want to touch that 3%, that really low interest rate. They'd like to hang on to that for as long as they can, and I completely get that. I have the same thing with me. That being said, let's go. I'm Derek Meyer, owner and operator of Hixon Mortgage. We are responsible for helping 350 families in 2025 alone get into homes. And today we're going to talk about a little bit about HELOCs. So let's dig in. According to Mortgage Monitoring Report, American homeowners are currently sitting on $17.8 trillion in home equity. Of that figure, $11.6 trillion is what the industry classifies as tappable equity, meaning capital you could access while keeping the standard 20% stake in your home. I just find that hard to believe, $11.6 trillion. That's a shit ton. That number isn't from the stock market. It isn't from crypto. It's not some hedge fund vault in Manhattan. It's sitting inside the walls, owned by everyday Americans. 48 million people own homes in this country. And according to ICE, that same report says that there's people with that kind of money available. So average mortgage holder is sitting on roughly $200,000 in tappable equity. So here's what makes that statistic absurd. According to ICE data, mortgage holders have only tapped a fraction of that. They're holding the vault. Most of them don't even know where the key is. If you own a home and you don't understand how this works, you're leaving the single biggest financial weapon you own completely on the bench. So let's fix that. Let's educate you on that. Today, we're going to talk through what equity actually is, how a HELOC turns it into usable capital, how a HELOC is priced and structured, the 4 legitimate plays, the 4 real risks, and what current market data says about timing. Education first. Decision second. Let's just start with the foundation. Equity is simply the difference between what your home is worth and what you still owe on it. If your house appraises at $600,000 and your mortgage balance is $300,000, you have $300,000 in equity on paper. But equity on paper is not money in your pocket. It's simply potential. According to Bankrate's most recent analysts, citing ICE data, which is mortgage data, 46.2% of all mortgaged residents in this country are now classified as equity rich, meaning the outstanding loan balance is less than half the home's value. Nearly half of mortgaged America is sitting on serious wealth they cannot directly spend. To convert paper equity into usable capital, you have three options: sell the home, refinance the entire mortgage with a cash out, or open a second lien product like a HELOC, home equity line of credit. Most homers locked in mortgage rates in the 3s and 4s during the last cycle. So refinancing into today's rate environment where 30-year fix sits near 6%, and as I write this, just curbed 7%. Yahoo Finance and Curino's data destroys the real wealth. Trading a 4% mortgage for a 6% first mortgage just to access cash that's not good. Mathematically, don't do that. That leaves the second lien in play, and that's the HELOC. So again, HELOC stands for home equity line of credit. Mechanically, it works like a credit card secured by your house. The lender opens a credit line based on a calculation called combined loan to value, or CLTV. Most lenders cap CLTV at 85%. You can go higher, then all of a sudden you start introducing mortgage insurance. We traditionally use a rule of thumb of around 80%. And if it's a second home or a investment property, traditionally 70%. But anyways, mechanically, there's various products out there. So the math is straightforward. Take your home's appraised value, multiply by 0.085 in this circumstance, subtract your existing mortgage balance, and the difference is roughly the maximum amount you qualify for a HELOC. A real example: your home appraises at $500,000. 500,000 multiplied by 85% is $425,000. You owe $250,000 on the first mortgage. That leaves $175,000 of borrowing capacity available on a HELOC. That could be your line. But here's the critical mechanic: you don't have to use the whole thing. You only pay interest on what you actually draw. If you pull $20,000 out of a $175,000 line, you pay interest on $20,000. Pay it back, the line resets, and the full amount is available once again. Most HELOCs follow a two-phase structure: a draw period and a repayment period. According to Bankrate, the standard layout is a 10-year draw period where you can borrow and repay freely, often with interest-only minimum payments, followed by a 20-year repayment period where the line closes and you pay down what you owe on an amortized schedule. Now, I know that was a lot to take in, all the more reason to talk to a lender, because it sounds like a lot. It's really not. You just need to take time, sit down, write it out, and have someone who's educated on the process kind of advise you on what to do. Let's talk pricing. So HELOCs are usually variable rate products indexed to the U.S. prime rate. You can Google that. As of mid-May 2026, the prime rate is 6.75%. Lenders then add a margin, typically anywhere from 0 to 2 points, 2 percentage points, on top of prime to calculate your specific rate. According to Curino's data reported by Yahoo Finance on May 17th, 2026, the national average HELOC rate is 7.21%. For a fixed home equity loan, that number sits at 7.36%. Now, compare those numbers to your alternatives. According to the Federal Reserve G19 consumer credit data, the average credit card APR in the early 2026 is roughly 21%. Gross. Personal loans average around 12%. And the New York Federal Reserve's most recent household debt and credit report, Americans collectively carry $1.25 trillion in credit card debt. Now let that sink in. The country is buried in 21% revolving debt while sitting on top of $11.6 trillion in equity that could be borrowed against roughly 7%. Holy shit. That's a 14-point spread. On every $50,000 of debt, that spread is $7,000 per year in saved interest. How do you deploy a HELOC responsibly? There's really four plays. Play number one, debt consolidation. The math is direct. $50,000 in credit card debt at 21% costs you $10,500 a year in interest. The same $50,000 on a HELOC at 7% costs you $3,500. You don't change what you owe, you change what you pay in interest, and you save $7,000 a year. But realistic caveat, if you consolidate the card balances and then run the credit cards back up, you've just doubled your obligations. That HELOC is not a cure. Your spending behavior is. Fix the leak before bringing in more buckets. All right, play number two, home improvements that add appraised value. Kitchen remodels, finished basements, additions, energy efficient upgrades. These are the projects that put dollars back into your property's appraised value. So you're using equity to create more equity. And there's a meaningful tax angle here. This is just for educational purposes. But according to the IRS publication 936 and rules established under the Tax Cuts and Jobs Act, HELOC interest is generally tax deductible when the funds are used to, quote, buy, build, or substantially improve the home that secures the loan. The deduction is currently limited to interest on up to $750,000 of combined mortgage debt for joint filers, $375,000 for those filing separate, and you have to itemize on a Schedule A to claim it. Most people use standard deductions. Again, I'm getting in the weeds here. Please consult your CPA. But most people do standard deductions, so you have to itemize it on a Schedule A to claim it. Using the HELOC for a $30,000 kitchen remodel, and that interest may be deductible. Use the same $30,000 for a vacation, and it's not. So, again, talk to your CPA. Don't take tax advice from some dumb YouTube video guy. Play number three, income-producing assets. This is the move that separates wealthy from everyone else. They borrow against assets they already own to acquire more assets that pay them. A HELOC at 7% to fund the down payment on a rental property that cash flows 9%. A HELOC to acquire a duplex, you can house hack. A HELOC to capitalize a real business with documented revenue. Let me show you the math. Let's say you pull $100,000 from your HELOC. You use it as 25% down on a $400,000 duplex. You live in one unit. You rent the other $1,800 for a month. That rent covers most of your new mortgage payment. You're paying 7% on a HELOC, but you now control $400,000 of appreciating real estate that a tenant is helping you pay down. That is leverage. It's risk, it's calculated risk, but it's also leverage. If your investment thesis is, quote, I'm going to flip houses I saw on TikTok, that's not investing. That's gambling with your home as the chip. Don't do that. Play number four, the strategic reverse. You open the HELOC, you don't draw a dollar, you just let it sit there, available, ready. Why? Because life does happen. Job loss, medical event, the roof actually goes. And when life happens, banks tighten credit standards. The worst time to apply for a loan is when you actually need one. The best time to set it up is when you don't. Most HELOCs charge minimal or no annual fees on undrawn balances. So you can carry a six-figure credit line attached to your home as an emergency reserve, costing you almost nothing, and never be forced to liquidate retirement accounts during a market crash to cover a bill. That's not paranoia. That's just good planning. All right, now the honest risk, because I told you we'd be real. Risk one, variable rate exposure. Because most HELOCs are tied to prime, your rate moves when prime moves. The Federal Reserve cut rates 3 times in late 2025, which is why HELOC rates have dropped to multi-year lows. But according to LendingTree's tracking, the Fed has held steady through the first 4 meetings on 2026. Some observers are now speculating that the next move could actually be a hike than a cut. And I don't disagree with that. I definitely can see with our currently, as I shoot this video, we're having a conflict in Iran, which is causing oil prices to spike, which is inflationary in nature, which is scary in nature. And then all of a sudden, you know, the S&P just broke 50,000. We've got a really good, strong economic outcome. So I wouldn't be surprised if we see a hike. I wouldn't be surprised. So in this circumstance, that can add a layer of risk to it. If prime climbs a full point, your monthly carrying costs on a $50,000 balance increases by roughly $44. Not the worst thing in the world, but it's an increase. So stress test your math against a 2-point rate increase before borrowing, and we will help you as lenders. Risk 2, your home is collateral. If you default, the lender can foreclose. Same as your first mortgage. A HELOC is not just a credit card you can walk away from. This is your home. Treat the decision with that weight. Risk 3, the draw period does end. After year 10 on most HELOCs, the line closes and an amortized repayment begins. If you've maxed out the line and you were paying interest only during the draw period, your monthly payment can double or triple overnight when the amortization kicks in. So make sure you read the loan disclosure. Make sure your lender is communicating with you and helping you kind of understand the risk and the reward on both sides of that objective. Mark the calendar, plan for the transition. Most HELOC lenders are required by law to send you a 60-day notice saying, hey, this thing's going to freeze, and they'll probably try to entice you to reapply, but most of them will freeze and then they become static and you can no longer draw off of them. Risk 4, fees and teaser rates. Some lenders charge annual fees, inactivity fees, or early disclosure fees. Many advertise introductory rates near 6% that would revert to a substantially higher rate after 6 to 12 months. The cheapest advertised rate is not always the cheapest loan, so make sure that you're checking on that. Compare the annual percentage rate, the APR, not just the headline number. Make sure you read the truth in lending disclosure before signing, and you reiterate with your lender that you want to understand all aspects of the good and the bad. Okay, a quick word on qualification. According to standard underwriting guidelines used by most major lenders, here's what they're looking for. Combined loan to value at or below 85%, 80%, 75%. They're going to look at that. Credit score of 620 for a basic approval, 700 and above for the best rates. Debt to income ratio below 43%. 2 years of documented income, tax returns if you're self-employed. You don't need a perfect file. You just need a clean one. All right, here is your action step right now this week. Step 1, pull your most recent mortgage statement. Find your principal balance. Step 2, reach out to a lender and help them see if they can help you get a current value estimate on your home. A recent appraisal, a comparative market analysis from a local agent or a lender, or a free online valuation tool is a great starting point. Step 3, subtract the balance from the value. That is probably generally your raw equity. Step 4, multiply your home value by 85% in this example and subtract your existing mortgage balance. That's your approximate HELOC capacity. Step 5, get written quotes from at least 3 different lenders, myself included as one of them. According to the Mortgage Bankers Association, home equity loan originations are projected to climb 12% year over year in 2026. Lenders are competing aggressively. The spread between the best and worst offers can exceed a full percentage point. And on $100,000, that's $1,000 a year in unnecessary interest. So make sure you know your number. Most Americans treat their house like a piggy bank they can't access. They watch Zillow values climb, feel wealthy for a moment, and then go right back to financing their lives with 21% credit cards. Per Federal Reserve data, the country is doing this to the tune of $1.5 trillion in revolving credit card debt. And I think I said that earlier. Some of those people are sitting on 6 figures of equity beneath their own feet. That's a choice. It's an expensive one. I just think you need to educate yourself on the process to see if it makes sense to keep that credit card at 21, 30%, or if potentially tapping your home equity makes sense. You don't have to make that choice. The capital exists. The lenders want to compete for your business. $11.6 trillion is on the table, not for you specifically, but the country in general. Some of it is yours. The question isn't whether you can access it. The question is whether you understand it well enough to use it without getting hurt by it. Now you do. Now, I will remind you, this content is for educational purposes only. I am interested in becoming your loan officer, my team here at Hixon Mortgage, but I am not your financial advisor. I am not your tax professional. I am not your attorney. All loan products, rate terms, qualification standards, they vary lender by state. I am in Oregon, Washington, Idaho, Montana, California. Please reach out to me. Everyone is different by different circumstances. Borrowing against your home carries real risk, including the potential loss of your property through foreclosure. Make sure you consult a licensed mortgage professional and a qualified tax advisor before making any decision. I'm out.